as one of the world's largest rating agencies that provides a little bit of that guidance on those guidelines that different folks on either side of a deal need to be looking at?
Yeah, sure. So I'd say from the banks and insurance point of view, we very much follow the regulatory capital rules. And actually, just raising a point that you made earlier, it's not all banks can receive zero risk weighting on these. There's two ways under the Basel capital adequacy rules that banks can judge their capital. One is the standardized approach and one is the internal ratings-based approach. And you know, for eligible guarantees, you can switch out the obligor for the guarantor. So in many cases, if you have a single B minus obligor and a AAA rated guarantor, then you're switching out 150% risk weight for a zero risk weight. So it's hugely beneficial. But you can only do that if you meet all of the legal and operational criteria, and one of which is prompt payment. Basel doesn't define prompt payment in the standardized approach, but a lot of national regulators are looking at kind of 60, 90 days. Many of these guarantees have 180-day plus payment periods. So that means that they wouldn't qualify under the standardized approach. There is a little bit of a ray of light on that for the banks under the standardized approach that want to do this. For example, recently the UK PRA issued a consultation paper where it was looking at making guarantees that have a 0% risk weight guarantor from someone like the World Bank, a supranational, exempt from that timely clause. Under the internal ratings-based approach, which I think is really what you were referring to, it's split between PD and loss given default, which means that you don't have the same prescriptive criteria. So you could say, okay, even though we have a high probability of default, we have a very, very low loss given default, because we expect that guarantee to come in. I'd say there are really two important points that are worth discussing. One is the fact that Fitch is a first dollar of loss rating agency. And that has a big influence on these things, because many of these, they're partial credit guarantees. So maybe they might guarantee as much as 95% of the principal, but there's still 5% that's not. Now, we're a first dollar of loss agency, so if you're going to lose 5%, you're still going to lose. So we can't give very much benefit to that. And you can, we've seen different structures, and I think it's probably worth just spending a minute.
What's guiding you, your principles on that, essentially?
So that's really what our rating definitions are. Okay. And so anybody that uses Fitch's rating definitions, or Fitch's ratings, is expecting our rating to address that likelihood of losing any money, rather than an expected loss style of methodology. And
so when there's new laws coming in to fold, or guidance coming in from the Basel Committee on shifting in most of those countries from Basel II to Basel III, and the finalization of 3 and 4, where do you see the trend actually going forward?
So what I'd say on that, again, that's shifting back to the banks and insurance companies. What I'd say is the most interesting development on those recent revisions was in December, when the Basel Committee came out with a revised approach for risk weighting standards, which introduced an output floor, very similar to in the US, your Collins Amendment. And what that is doing is it's saying that it's limiting the benefit that you can get from an internal model approach to 72.5% of your standardized approach. Now this puts a lot of, I think this puts a lot of pressure on these guarantees to become eligible under the standardized approach. Because if they're not, then suddenly that's a very different world for all banks under the standardized approach or the IRB. And to come back to the timely point, not for bank regulatory capital purposes, but maybe for the ratings of project finance and structured finance, when we're reviewing these transactions, because there's so much uncertainty regarding when the guarantee will actually pay out, in some transactions we have 2 years or 4 years worth of liquidity gap there. And so those ratings can be much lower, or their transaction has to have a very large reserve fund or liquidity facility to reach the same rating. So it's not about necessarily putting more capital at play, but it's the rules at which that capital is put out that have a very large impact on how we view the risk, and I'm sure how others view the risk as well.